Good morning. Welcome to Stock Market Today for Monday, May 4th, 2020. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where we get a lot of the content for this show, as well as give you daily stock ideas to consider upon further research. That hits your inbox every trading day before the market opens. So U.S. equities finished lower in Friday's trading near the lows of the session. All sectors closed in the red, with energy the worst of the bunch. Treasuries were mixed, with the curve flattening. The dollar was weaker versus both the yen and euro. Gold finished up 40 basis points. WTI crude closed up 5% and rallied over 15% on the week. Like I said, all sectors finished lower last on Friday. Consumer staples were the least bad, followed by comm services. And as we get to the desk this morning, futures are under a bit of pressure, down about 1%. After kind of fading Thursday and Friday last week, giving back some big gains seen earlier in the week. Asian markets were mostly lower overnight, though China and Japan were both closed for a holiday. European markets, which were closed for the May Day holiday on Friday, come back, and they are under pressure here this morning. Treasuries are stronger across the curve, and the dollar is seeing some solid gains against the euro and the pound, but lagging on the risk-sensitive yen cross. Gold is up 90 basis points. WTI crude down 8% to get us going on a Monday morning. And let's dive in and look at the structure of the S&P 500. Kind of stuck in a little bit of a no man's land here, right, if you will. We faded from the key retracement at the 61.8% retracement of this entire move down. Remember, was at about 29.30 or so. Had some other resistance at around 29.50, and we faded from there below the 200-day moving average, which is at 30.05. We're kind of stuck now in between this support and resistance zone, right? Initial support 27.50 to 2800, and then below that kind of 24.85 to 26.60 by my work. Resistance 29.50 to 30.05. We have the 50-day moving average at 27.58. We have the 200-day moving average at 30.05 again. So really just kind of stuck in this no man's land, right? It could go either way from here, quite honestly. Or, I think the worst case scenario, not the worst case scenario, but what would frustrate the most people at this point, I think, would be just to chop around sideways and just kind of break somebody's spirit, whether it's the bulls or the bears. Near term overbought, and rounding out of that overbought condition, Chaikin money flow is bullish. So I think we're kind of directionless for the time being, with a slight downside bias given the activity Thursday and Friday. But I do think sideways would frustrate a lot of people, right? Because if you were banking on a fast collapse from those resistance levels and we chop sideways, that would break your spirit if you were a bear. And if you were banking on a continued rally and an easy leap over the 200-day moving average, and all we did was chop sideways, well, to me, that could potentially break your spirit if you're a bull. So it could go either way here. Stay engaged with the market. Let's look at our market in a minute now. What are we writing about in our note today? Well, we hit strong resistance and fade. We talk about that. Small caps reverse recent bout of relative strength. Remember small caps from our chart on Friday. We're going to revisit that chart here today. Treasury consolidation continues. We favor an upside resolution in price, downside resolution in yield. U.S.-China trade tensions are resurfacing. I'm asking the question. Some commentary over the weekend from President Trump about potential tariffs, or late last week. So kind of an interesting dynamic. Throw another log on the fire, if you will. Futures do point to a lower open here today. Taking a look at the major indices now from a power bar perspective, the Dow lost 2.4% last on Friday. 2 bulls to 14 bears there. S&P 500 weakened, down 2.6% on the day. 41 bulls to 172 bears. Right, NASDAQ briefly tried to go positive last week, remember? This ratio was positive on Friday when we were talking about it. Back to the negative side, down 2.8% on the heels of a lot of key names under pressure in the NASDAQ on Friday, right? Apple and Amazon on the heels of their earnings. A midday tweet from Elon Musk on the nature of his stock price for Tesla. He thought it was too high in his opinion, so investors promptly sold his stock off to, I guess, prove his point. So the NASDAQ under some pressure. Small caps down 3.9%, big underperformer. And that ratio shifts back to the bearish side as well. 247 to 413, bulls to bear. Bonds uptick, sending yields lower, according to the Chaikin Power Bar. Large cap stocks are more bearish than small cap stocks. Major indexes mixed. Let's hit our stock of the day, though. Speaking of the NASDAQ side, look, the Qs, in my opinion, are still the best game in town from an index perspective. So I want to be looking for the best names in the best market, right? And to me, one of the better names out there is Google. Alphabet, if you will. It'll always be Google to me. Bullish rating here, Chaikin Analytics. Strong trend, strong industry group, right? Holding above the long-term trend line, which is beginning to turn higher. Now, the rating just turned bullish. On a relative basis, we're seeing an increase in relative strength. Overbought, oversold indicator beginning to move higher after failing to reach an oversold condition. Now, I'd love to see a little more out of money flow. It's neutral, but all things considered, weight of the evidence approach, a name like Alphabet or Google looks fairly compelling to me on the long side of the portfolio. Now, as always, you want to be managing risk. Remember, it was a solid risk management process that allowed you to sidestep a lot of the move lower in the market through February and March. And a lot of people had reached out to me personally. This is saying that they really didn't have a risk management process prior to following a lot of what I was saying, and that it helped them. And also a fair amount of people said, I should have listened, should have had a risk management process. Kept trying to buy them, kept trying to catch the falling knife, and those people got hurt during the downturn. It's a process. Manage your risk. It's more important than anything else. Take a look at our sector tracker now, the movement of the major sectors over the last 5 days. Energy remains at the top of the list, right? Counter trend rally. Counter trend as far as I'm concerned. I don't care. It's interesting, but it's still counter trend as far as I am concerned. I don't have enough evidence to lead me to believe that that's the start of an uptrend for energy on a relative basis. But, all uptrends start with a counter trend rally. So right now it's counter trend in my mind, but my mind always stays open. Comms, materials, fins round out the top four. Energy and tech, industrials and tech, also positive over the course of the last week of trading. Discretionary kind of interesting. Flat over the past 5 days. Did see news this morning. It was kind of hinted at last week, and the news crossed the tape this morning that J. Crew filed for bankruptcy. Expect more in the retail space. See how that weighs on the discretionary group. I don't think it's a surprise to anybody. I think, just like energy, a lot of people are expecting a fair amount of bankruptcies in the retail space. So we'll see how that plays out and what that does to the stocks. REIT, staples, healthcare, and Utes are defensives towards the bottom of the list here. Take a walk at Utes here. Because I do think that rates are ultimately heading lower, which should be a benefit to the Utes. But maybe in the near term, it could be some choppiness. We'll take a look at a chart of that a little bit later on in the show. Let's hit our industry in focus to now. Dow Jones REIT Services, speaking of kind of defensive areas of the market that aren't acting like it. Over the past 6 months, this group has underperformed the S&P 500 by 18.25%. Power bar ratio, which measures future potential, is very weak. Has one bullish stock, 36 bearish stocks, and it's currently ranked number 18 of 21 subsectors, having moved down 2 slots over the past week. So names in there that we want to avoid. Very bearish ratings here at Chaikin Analytics, SL Green, Healthcare, Realty, HR, and Public Storage, PSA. And as we take a look at the structure of the fund here, counter trend rally looks to be running out of gas, right? Neutral rating for RWR, but there's that ratio 1-36. Weak trend below our declining long-term trend line. Kind of middle of the road here as it relates to the bands, but a big underperformer since November, right? Big underperformer since November. And what's interesting is your traditionally defensive REIT and did not help you through the downturn. Because I think that a lot of the REITs are the commercial real estate, mall-based retailers. Those are the names that are under pressure here, right? So you have to dig in through the REITs. You can't just blindly say, "Hey, REITs are a safe haven. Let me own them." If you did that, if you took the lazy trade and didn't do the real work, you got hurt. And REITs just don't look compelling to me at all. Taking a look at what's trending now, a lot of this is earnings related, so I'm not going to spend a ton of time on it. Fortune Brands, FBHS, up 6.85% on the heels of their report. Clorox, 3.36%. AON, bearish rating, 3.2%. Charter, CHTR earnings in that stock higher by nearly 2%. Willis Towers Watson, I believe part of an M&A deal as well, up 2.8% on the heels of their print. Weyerhaeuser, WY, here's a REIT, by the way. Reported earnings, stock down 17%. Norwegian and Royal, nothing company specific, driving a lot of volatile trading in those groups. Helmerich and Payne earnings, patchy, no real news there. APA to drive that stock lower by 13.75% on the day. But we still are in the heart of earnings season. So that is driving a lot of the individual stock trading on top of just kind of the themes that are out there from a macro perspective. So I said we talk about yields. Here's the 10-year TNX, CBOE 10-year Treasury Index. And what I see is taking a break for now, right? I see a precipitous downtrend that accelerated to the downside with COVID-19. But again, the trend was in place, right? Below 50-day, below the 200-day moving average, right? So from a long-term perspective, the downtrend was in place. COVID-19 accelerates it to the downside, and then we get some volatility as we try to stabilize. What's interesting to me is at no point in the past year has the RSI of the 10-year yield been overbought. All right, so that just goes to show you the strength of the trend. As you know, numerous times it was able to become oversold. We're kind of middle of the road now during this consolidation. You know, I think we need some time to work off this move, right? This was a fast move to the downside. So I think we need some time to work that off here, consolidate. Ultimately, I do think odds favor a downside break in yields. That would be an upside break for the product that you would own if you were, say, maybe looking at the IEF, the ETF that tracks the 7 to 10-year Treasury yield. So just something to keep in mind. This looks like a pause within the context of a downtrend. I think the odds favor a downside resolution in yields. Ultimately, the market doesn't care what I think, so we'll monitor it. So what would make me wrong? What would make me wrong would be a break kind of above the 200-day moving average, which would then open the door for a move back up towards, 1.3 to 1.4. What would kind of support my view will be a break of this slight uptrend line here. So watch that kind of, if you broke back below 60 basis points, then the door would be open to further downside as far as I am concerned. As it relates to gold, I think we have a textbook uptrend. Here's the price of gold, a continuous contract in a nice steady series of higher highs and higher lows. Above a rising 50-day moving average, above a rising 200-day moving average, which acted as support to the initial downturn, right? If we look at the 13-period CCI, we're nearing the levels that would mark oversold, all the while holding up on a relative basis against equities, against the S&P 500 with, so a little bit of a consolidation here in the near term. I'd be watching this closely. If you're an equity bull, and this ratio breaks out, you have to kind of question what's going on there in the equity market as far as I'm concerned. If you're an equity bull. If you're an equity bull and gold begins to really outperform once again, right? Big bout of outperformance, consolidate. If we start to outperform once again and you're an equity bull, you got to start asking yourself, why am I an equity bull? And if you can answer the question, great. But if you can't, you have to start thinking about changing your tune as far as I'm concerned. This is one I'm watching closely, as I always do. And then finally, I said we'd look at it. Here's small caps IWM against SPY. This is the exact same chart we looked at on Friday, except now we've broken back below the breakout level. So is this a false move? Time will tell. Did not become overbought. Potential breakdown on an absolute basis, all while trading below a steadily declining 200-day moving average. Tells me that this looks like a counter trend rally and the weight of the evidence still supports lower and the burden of proof is on the bulls. That'll wrap us up for a Monday. Hope you had a great weekend. Head over to chaikinanalytics.com/test drive. I'll be back with you tomorrow.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.